Well, greetings and salutations, Series 57 test takers. Such great news. A big shout out to Ian and the KnopmanMarks team. One of the most favorite pieces of content on the channel is explicated practice tests. And we've had some 57s are using Knopman. Not a lot of people are offering it anymore. And asked for an explication. I reached out to KnopmanMarks and said, hey, could we explicate one of your practice tests? And, not only will it help the people who have made an investment in your content, but also maybe future people looking for some content. When I get permission, like I did here just yesterday, the first thing I do is buy the product myself. I go online and I register and, download the content. And I got to tell you, first class all the way. So this is the benchmark. I've chosen to use this for our explication this morning. And let's get started. All the following requirements must be met for a firm to qualify for independent unit aggregation, except, don't you love the language? So here we have different trading desks, and maybe those different trading desks are different profit centers. Like, maybe fixed income is separate from our, trading operations and equities, or options is separate from equity and from fixed income, for example. So it says all the following requirements must be met for a firm to qualify for independent unit aggregation, meaning we're going to treat, the rules as independent or unique to each of these units instead of as a whole. So that's what that means in English. Each unit must determine its own net position for every security. Now, remember, this is an except question. And so we're looking for something that is false. A is indeed true. Each unit must maintain its own available securities list. No, that's not true. We can have one list for, available securities. C, the firm must have a written plan to identify each unit. Yes, traders can only be assigned to one unit. That's true. So the answer here is B. Now let's see if this is going to let me do this. One thing is this is downloadable. Some of the content you get is not downloadable. But this is, and so I'm a big fan, if you've been with me for a while, what I call a poor man's flashcard. So if you print this document out from Knopman, one thing you can do is then turn it into a poor man's flashcard. Boom. And the way you do that is you get rid of the except, right? And now you have a poor man's flashcard where you can, night before the exam or morning of, go through and read the questions and the right answers. Don't be studying on truthful information. So now as a poor man's flashcard, this reads, all the following requirements must be met for a firm to qualify for independent unit aggregation. 1, each unit must determine its own net position for every security. 2, the firm must have a written plan to identify each unit. 3, traders can only be assigned to one unit. So again, you might want to consider doing that with this benchmark exam from Knopman. For us, the answer is going to be B. Boom. Number 2. Abe is long 100,000 shares of issuer K and places 3 separate orders simultaneous to sell 10,000 shares of K with his firm. I kind of like this one. So what they're asking us here basically is, what are we net long in this scenario? Right? If I'm long 10,000, I've sold 30,000. It looks like I'm only going to be able to mark one of these orders long, right? 2 orders can be marked long? No, because that would be saying I have 20,000 shares that I can deliver. B, 2 orders will be marked short against the box. No, short against the box is when I'm, selling short. I call my broker and say, hey, put these shares in the box, your vault. That's what the box is. And then sell borrowed shares. That's not what this is about. So anyways, that's wrong. They all must be marked short. No, there we go. D is in dog, right? Where'd my annotation go? So 2, the answer is D. I would expect you get, I don't know about the phraseology here. I like the question, but be prepared for a question along the lines of net long. So, well, one of the reasons 57 is a lot harder than it used to be is Mr. Manning. Mr. Manning followed a class action lawsuit against NASDAQ market makers. Someday, after you pass your exams, I highly recommend Chairman Levitt of the SEC wrote his memoir, Taking on the Street. And a lot of the rules that we now have come from that era. And, Mr. Manning got so upset, he filed a class action lawsuit. He said, I can see, Dean, that you're willing to buy this stock into your inventory at 15, and I'm willing to buy it at 15.05, and yet I don't see anything going on. And what I used to do in the old days is buy it at 15 and then fill them at 15.05. You can think about it as stealing a nickel from Mr. Manning, right? So now we have to actually, have limit order protection rules. So I'm sure we'll run into some limit order protection rules here in terms of practical examples of that. But the answer to the Manning rule is number 3. It's about limit order protection. So the answer is A. Post-trade execution reports should be provided to appropriate surveillance personnel in compliance with broker dealers. So, I think of this back office stuff is what's happening backstage, and it says post-trade execution. So this is the plumbing backstage. Regulatory risk management controls, no, that's big picture. Trading risk management is, real time. It's not like after the trade. Credit risk, no. Financial risk management, there we go. The answer is D. Right. So financial risk is, systematically, making sure that what our financial exposure is, after the trades that, we can make delivery, do all those things we need to do, to make sure they don't exceed, whatever parameters we have. Brian calls his registered rep of EDD common stock. The rep indicates national best bid or offer. That's what that means. So you should definitely know that's the highest bid and the lowest ask. So the rep indicates it's 25.64. That's the highest bid. And 25.69, that is the lowest ask. You should definitely know that could be referred to on your exam as the inside market or the inside quote. The size is 12 by 4. So that means that some firm out there is willing to buy 1,200 shares into inventory at 25.64. And some firm out there is willing to sell 400 shares at 25.69. Remember, the quote is always from the dealer's perspective. So the customer always buys high and sells low. What's that called? The securities industry. I'm joking, but with a market order, the customer is on the other side of this trade. So you really got to be careful as a test taker about what I'm asking about a market order or limit order. I would refer to you to 2 lectures I have on this. One is called Know Your Bid from Your Ask, and another one is on market making itself. Well, I'd like to have a third, limit order protection as well. By the way, when I bought this Series 57 from Knopman, ooh, boy, lots of videos, lots of supplements. So, I remember my content is a free supplement, not a substitute for paid study materials. So you're going to need some paid study materials, and maybe you don't even need a free supplement if you, buy the Knopman. It was $350. I used a market order to buy it. So I didn't, I'm sure, I know they have coupons or discounts or any of that kind of stuff. I just, wanted immediate execution, best available price to get this up there for you. Anyways, Brian places a directed market order to sell 500 shares on NASDAQ. What price should Brian expect to receive for his shares? I like the way they phrase that, right? Because things could happen, but Brian should expect 25.64, right? He's the seller. So boom. Now, if they had the same question, and it said he's a buyer, then he would expect 25.69, right? So the answer number 5 is A. Number 6. If a market maker submits appropriate documentation for an involuntary termination of a clearing agreement. So, maybe I'm using a Pershing to clear my trades, or National Financial, or whoever it happens to be. They will be, involuntary is kind of a red flag. That means it wasn't my choice to leave my clearing firm. It was them kind of booting me. So they will be granted an excused withdrawal for 60 days. So this, by the way, this is what I call an aim and shoot point and click question. Whoop, excuse me here. I don't know how I can erase my highlight. Here we go. The 3 styles of questions you get are recognition. This is a recognition test question. Practical application. Practical applications like where we have a limit order, we got to decide how to update display. And then you get judgment questions. And judgment questions are those ones where you go, you get into a 50-50. So my point is, don't give up aim and shoot point and click questions. Again, if you do sign up with Knopman for your 57, please tell them that I sent you their way. But also remember, the great thing about a old-fashioned dead tree version of this thing as you print it is you can turn it, as we said, into a poor man's flashcard for these recognition questions. Now, Knopman also has their own flashcards available as part of the package. I haven't looked through the flashcards yet, but I sell their flashcards there as well. All right, so passive market makers. Number 7, a passive market maker for a covered security. So, if we're doing a follow-on offering on the investment banking side, it's kind of a conflict of interest for us to be involved in the primary market and the secondary market at the same time. So we go to you, the 57, and we say, hey, what do you want to do? Do you want to, take a vacation? I'm joking, take a day off or whatever, or do you want to go passive? Most of us would say, I'd like to go passive. And so that's what that means. A passive market maker may bid for a covered security. And the answer to this is D. We can't be higher than the highest independent bid, because, then that would make it look like it's not a test term, but an OG term. It would look like perhaps it's a hot instead of sticky, right? So that's kind of what that's about. So the answer to 7 is D as in dog. According to regulation show, SHO is about short sales. It's about short sales, and it's typically about a locate requirement. And if we aren't locating, what exemption are we availing ourselves of, right? And so here it says long exempt. Well, that should be a dead giveaway, kind of, because there's no such thing as long exempt. It's about short sales, and there's no exemption necessary if we're long, right? So this is A. Broker-dealer G operates several market centers that are required to post monthly data on execution quality. So, what we have in mind is, maybe Goldman Sachs has several trading platforms or ECNs that it's operating, whatever the case may be. G must maintain an internet site that includes. So, people, we have an obligation to disclose, execution quality. And so here the site includes the SEC requirements for posting, now all data, a list of the links where those can be found. So the answer is C. And again, that would be a good, perhaps a poor man's flashcard again. What I mean by that is maybe what you want to do is it's C. And then again, what you might want to do is take your poor man's flashcard thing again. Please don't call me and ask me to send you anything. That's not what we do on the channel, and we don't violate copyright. So if you want to have a copy of this, the place to get it is by signing up with Knopman. But anyways, that being said, assuming you do, this would be another good poor man's flashcard, another good poor man's flashcard. Number 10, a market maker in an OTC equity security is required to maintain a minimum quotation size. Now, remember, this is not a NASDAQ security. It's an OTC equity security. So maybe you think, I remember this thing about 100 shares. So here it's going to be based on the bid and offer price of the security. Based on the average number of the market. I'm just checking for the distractors, because sometimes what you want to be able to do is process of elimination. And so, I can say, well, gee, I've never heard of anything like A. Based on the number of securities? No. Inversely proportional. I love that distractor. What I'm saying here is I probably could have done this through process of elimination. A trade report is executed at 9:15 a.m. and is reported 1 minute later. Whoa. You should know that that's a problem. That is definitely a problem, right? Because if it's executed between 8 and 9:30, it's supposed to report it in 10 seconds. I would know that. So right out of the gate, I'd go, man, this is a problem, because it's 10 seconds. This says 1 minute. So it looks like we should disclose that this thing has been done in a tardy fashion. And the modifier we're going to use for that is U. Trade modifiers. right? Those other modifiers, I would know some of the modifiers like T1, T2, T3, for example. So something you definitely want to have a handle on. Number 12. What is the deadline for filing a broker's dealer's quarterly report on order routing for the second calendar quarter? Well, now, sometimes questions like this are helpful because maybe I didn't know that I have to do this quarterly, but now I do. So thank you very much. So sometimes maybe they'll, give you a hint on what is going on. And the answer, again, this is another one of those recognition questions that we have to do within 1 month after the end of each quarter. So the answer to 12 is a C. Broker Ellen accepted a short sale from her client Ed. Okay, broker Ellen took a short sale. A, if Ed assures her that he will be speaking with another investor, will probably be able to loan the shares to Ed. Come on, you should have been very easily been able to eliminate that. That does not have any way, shape, or form fulfill a locate requirement. I got a friend who's got a friend who knows knows somebody, and that doesn't work. If the security appears on the threshold security list, no. C, if she hopes that Ed will deliver the shares within a reasonable time period. Well, you should know that when you're taking some kind of a regulatory test, you should stay away from certain pejorative terms like hope or always or never. We don't hope things happen. Broker Ellen has reasonable grounds to believe Ed has located the shares and will deliver them by settlement. That seems like the most reasonable answer given this answer set. By the way, when I get this done, I'll score it up, and if I've missed anything, I'll put it in the video description, or I'll hit pause and just come back and tell you what I missed one way or another. So if you're, what you should be doing, I kind of jumped right into this thing. What you should be doing here, question 14, is hitting pause, giving your answer, hit play, and then see how your answer compares to Dean. And then when we're all done, we'll figure, how we did with each other. I'm not so sure that you want to do the work necessary on this one. You have to do a minimum number of shares. Again, it's an OTC equity security, not necessarily NASDAQ. And, here we want to, I'm not so sure you want to do that, but it's based down on that section. So here it's A. And I'm just going to tell you that, if you are doing your homework or whatever, you can go refer to that chart. Me, I don't think as a test taker, I would memorize the chart and be able to do this. I think on this one, I would just guess B and assign it to the universe is how I would proceed. But, however you want to proceed, that's what you should do. 15. PPD is an OTC equity security. Broker-dealer X purchased 20,000 shares at 11:10 a.m. on October 14th. Okay. Broker-dealer X subsequently cancels the trade at 8:15 p.m. on October 15th. Notice of this cancellation. So when a trade is canceled after 8 p.m., which it is here, the cancellation notice must be sent by 8 p.m. of the next day, right? So it's going to be D. So, we're making you do practical application based on recognition. Right. 16. How many shares of stock are generally considered to be a block trade for purposes of the prohibition against front running? Front running would be trading ahead of a block trade. That's what front running is. And this is an aim and shoot point and click question. It is C. It is C. This is Mike. I'm having troubles keeping my highlighter in the right nifty spot. Sales of which of the following need to comply with indice rules? Well, stock futures aren't securities, so for purposes of the regulatory framework. And so the answer is A. I think you should probably be able to get that correct. Yeah, you should know bonds are securities, stocks are securities, preferred. So, futures have a different regulatory framework. They answer the regulatory framework there is the CFTC, not the SEC. And, for your own edification, they fight all the time about, is something a security or is it a commodity, right? Futures. All the following, we no longer have the pink sheets, but I still think the question is, valid. All the following, when, I told you I just purchased this off the shelf last night, and I'm sure there's an update page from Knopman. So if you run into some kind of a thing, whether your vendor is a Knopman or anybody else, you should always check on the dashboard where they update things. Knopman has a great reputation for being very, very current on changing regulatory framework and then how that impacts exams. Anyways, 18. All the following statements are true regarding securities that are quoted in the pink sheets except. So all the following statements are true regarding securities. You got to be careful on these except. So I always like to read them, one more time just to see what I'm being asked. I'm being asked, what is false here? What is false? The issuer is not subject to the initial pink sheet listing requirements. Yeah, I'm not quite even sure what that means grammar or English-wise, so I'm going to table that one. Most of the securities trade relatively infrequently, have a high bid-ask spread. Yes, I know that's true. So that's helpful. I can eliminate B because remember, I'm being asked what's false. Now, another thing you might want to consider as a test taker, this isn't your first rodeo if you're taking this, but another thing you can do is on your answer set on your official Prometric scratch paper, like for example, Dean tabled this one to do some further work. And this one I know is true. I could put a T there. And what I'm hoping is I'll be able to, continue down this answer set and be able to do something. All right. So C, the issuing companies are not required to file annual and quarterly reports with the SEC and other insurance or financial regulators. That's true. The reason a lot of times the companies that have ended up in the pink sheets are referred to as what we call fallen angels. If you fall behind in your reporting, your 10Qs, your 10Ks, you're going to get booted from New York, NASDAQ, and what used to be called the bulletin board. So that is definitely true. And then they have a warning next to the security that they're not current. All right, so now I've got a 50-50 here. So 50-50, let's see what D says. The minimum price of the stock included pink sheets. They helped me out on that one. I should know that's the answer now because I should definitely know there are definitely stocks that are below $1 on the pink sheets. I mean, these can actually, some of them can be in sub-penny pricing. So now I know, thank you very much. I now know that this answer is D by process of elimination. Boom. Whoop. Come on, Dean, get your highlighter together. 19, stabilization is very testable. I think of stabilization, again, what Dean thinks is not testable, but I think of it as a legal form of pegging. And I have a lecture on this, and you have your companion videos with your Knopman 57 course. So make sure you got this. This is for firm commitment underwritings or fixed price offerings. And better to have this in the prospectus and not need it than need it and not have it. And so one member of our syndicate is going to be the stabilizing agent or stabilization agent. And they're the ones who are going to, stabilize the price, right? If we're taking a company public at 20 and in the aftermarket, the secondary it's trading at 18, nobody's going to buy our stock at 20. So better to have it in the prospectus and not need it than need it and not have it. So now, again, not accurate. There can only be one stabilization bid at a time. That is true. True. I'm looking for something that is not accurate. An underwriter can stabilize an offering indefinitely. Well, yeah, I suppose. I mean, at some point, the manager is going to break the syndicate. An underwriter can never stabilize the public offering price. Indeed, that's very true, right? Because that would make it look like it's hot. An underwriter cannot initiate stabilization when the primary market is closed. That is not true. We can begin stabilization before the market opens. Maybe it's day 2 or 3 of this sticky issue, and we're trying to, make sure it opens up and we can sell. By the way, typically when we sell our shares, that's when we're actually going to then break syndicate. Again, on these types of questions, you might want to consider, that's what's great about the old fashioned. This is a downloadable exam. I chose this one purposely for that reason. Knopman gives you 3 of these dead tree PDFs that you can download. And one reason I'm a big fan of them, because I liked it to be able to do poor man's flashcard. So again, what I want to do is get rid of the not, get rid of the D choice. And now again, I'm assuming now you've printed this, you've got your Omarco, and now the night before or morning of your 57 or both, you're going to read the question and the right answer. which of the following statements regarding Reg M Stabilization Rules is accurate? There can only be one stabilization bid at a time. An underwriter can stabilize an offering indefinitely. An underwriter can never stabilize above the public offering price. Now, another thing you might want to do in the margin is annotate it with other questions you may receive in like fashion about stabilization. But make sure to put that on your, if you're watching this, I always say when you're watching an explication, you might want to have a notepad handy to make a note of things that you want to go back and take a look at or review or maybe lay a little more base knowledge on. And stabilization is certainly one of them, or would be if I were a candidate. In which of the following option positions does an investor have unlimited risk? Okay, so let's see. I should be able to eliminate A pretty quickly, right? I paid a premium. And when you pay a premium, the only thing you can lose is that premium. So A is out. For me to have unlimited risk, it has to be an obligation of some sort. I short 100 shares of ABC stock at 65. I'm a very smart bear. I joke, don't be a dumb bear here. So I've actually hedged the risk here. I've mitigated the risk by having a choice to buy back the borrowed stock at 73. So B does not subject me to unlimited risk. C, I'm long a call and short an 83 call. Well, so the worst case here is if I get exercised at 83, I'm going to exercise at 73. That is a debit call spread. So I don't have unlimited loss there, right? So by process elimination, I'm D. Now, by the way, if it sounds like Dean is speaking a foreign language as it regards to options, maybe you need to review some options. I did notice that Knopman has a 2-hour option video to refresher that is says that it comes from their 7 content. And, God knows I have, a whole playlist on options. So, your choice about where you're going to do it. So I would, sounds like a foreign language. Let's look at D. I have an obligation to sell at 73. That's what that contract specification is. I'm short a call and I'm short a put. That's a short straddle. And short straddles certainly do subject me to unlimited risk, right? Because, I have a naked call there, an uncovered call. And so the answer to 20 is D. And I kind of think that's a fair game, by the way. If you're working the trading desk, we want to make sure you know things that would subject, the desk or the firm to unlimited risk, or even a customer. As a 57, you're not typically interacting with customers. You're interacting with, order entry firms or, people, intermediaries, but, 21. Trading halts in OTC equity securities may be imposed by FINRA for a maximum imposed by FINRA for up to 10 days. Hey, another recognition question. So you want to make sure you get all your recognition questions you're entitled to. Member firms right out of the gate. I don't like this. So it says FINRA member firms are permitted to trade ahead of retail customer orders. So I go, wow, okay, this has got to be an exception. They're asking about some kind of an exception. A at all times. You should definitely be able to toss out A. Again, I said you should kind of shy away from pejorative answers like under no circumstances, for example. There are, always some kind of an exemption or way to do things. Sometimes we refer to them as safe harbors. It sounds like this question is asking about a safe harbor about retail customer orders, right? So C or D looks like it's going to be it. Of at least 10,000 shares with a value exceeding 10,000 with prior written consent. And then D says of at least 10,000 shares with a value exceeding 100,000. And so, this is going to be D. And boom, that's one of the safe harbors or exemptions under the limit order protection rules, right? So now so that would be another good one. So I'm just, by the way, I get no compensation from Knopman if you buy their product. But again, one thing I do like about this is there's all kinds of opportunities in this exam for poor man's flashcards, right? And again, night before, morning of, or both, just go through, I'll mark that out and read the questions or answers. Now, I'm not going to provide you with a rationale to this. I will provide you with an answer key. But again, you would have the rationale. I would do the same thing. I'd read the rationale, night before and morning of as well. Four conditions must be met to qualify for the safe harbor for issuer securities repurchases. We don't want the the issuer to be able to manipulate their own security, and there are companies like Apple and, Alphabet, that's Google, Microsoft, that have billions and billions of dollars. And if they chose to, they could manipulate their stock price, and that's certainly prohibited. Now, if the board of directors gets together and decides that the company has excess capital and wants to return some of that excess capital to the shareholders through doing share repurchases, buying stock into the treasury, retiring shares, that's what this is about. So they are. The manner in which we're going to be doing it, yeah, you can't be manipulating. You can't mark the close, for example, mark the opening, the timing. Well, I just brought up the timing, the price, and the volume. Yeah, A sounds pretty damn good. But there's nothing about depth in that rule. Again, that's an area that I would. So stabilization, and now we have this one. These are a couple of subject areas where I would review limitations, the rules about stabilization and limitations of issuer buying its own stock. And that would be something I would definitely spend some time on. An investor writes a XYZ 70 call for 5 when XYZ is 68 to establish a bear spread. Woo, this is kind of a tough one. Now, personally, I don't know why I would want to establish a credit call spread. Oh, please no. Yes, I would. I want to put in a ceiling here, right? I would like to be able to offset my obligation to sell at 70, which I have now, and which is presently naked and subjects me to unlimited risk, with a ceiling. There's a floor at 70, so I want to put in a ceiling. So I should say, okay, I'm going to offset my obligation to sell with a choice to buy. So now I know it's either C or D. And so now it says I buy a 66 call. No, that would end up being a debit. Lower strike calls have greater premiums. And so the answer to 24 is going to be C. And as somebody who's trading, we love credit call spreads because credit call spreads don't have unlimited risk, whereas naked calls do, right? So, if I were a series 4, I might even call you and say, listen, I'm not going to let you do naked calls. I'll let you do credit call spreads. Who knows? Maybe a series 4 is in your future. 25. The national best bid offer, the inside market, inside quote is 10, 10, 10. MDX is a market maker and has an existing bid on the stock. What is the lowest possible value for that? And the defined limit is 9.5%. So that's going to end up being choice B. So that's, by the way, what we call a practical application question. Now, again, I'm not so sure how much, you want to spend time on those kind of practical applications, but, yeah, it's up to you. It's B. By the way, that lowest possible value, 9.5, it varies based on the kind of stock it is. So, yeah, it's not as bad as stabilization. It's not as bad as limit order protection, but it's certainly there. 26. Market maker AA currently is quoting ABC Security, a national market system stock. So that's a stock that you've heard of, Apple, Netflix, that kind of thing, at 1040, 1050, 12 by 4. So you kind of want to practice, don't rehearse. You want to get real comfortable. I think it's easier if you put yourself into the question. So what I'm saying right now is that I'm willing to buy 1,200 shares into my inventory at 1040, and I'm willing to sell 400 shares out of my inventory at 1050. So, this is from the dealer's perspective, inside looking out. Market maker AA bid currently sits at the inside market. So now they're telling you that I have the highest bid and it's 1040. Which of the following customer orders would require market maker AA to update its quote? So very testable. This is limit order protection. So usually the customer with a market order is on the opposite side of the quote than I am. So if a customer is buying with a market order, he's paying 1050 and he's selling with a market order 1040. But if it's a limit order, he's on the same side of the market. So when it's a limit order, what I have to look at is see as if my customer's limit order is the same or better than mine. He's going to be on the same side. So customer here, our first one says the customer wants to buy 10,000 shares at 1041. The customer wants to buy 10,000 shares at 10:41. So which of the following require the market maker update its quote? A customer wants to buy 200 shares at 10:41, all or none. A customer wants to buy 200 shares at 10:40. So 10:40, that looks like that's either going to be A or C. You know, A is better than my quote, and C is the same as my quote. And if it's better, then I got to do it. D. So it doesn't apply to round lots, and it doesn't apply to block transactions. So this one was pretty tricky. So remember, 10,000 shares is a block transaction, and D is an odd lot. So those are kind of out. Now, I think on the test, it would be a little more straightforward. This one was pretty tricky. So again, maybe we want to annotate this one. What I mean by annotation is rather than putting this into a poor man's flashcard, I'm going to say here, that's a block trade. Here, this is an odd lot, and it doesn't apply to that, right? So a customer wants to buy, it doesn't apply to an all or none or contingent order like that as well. So, right, those are all exceptions. So the all or none, again, doesn't apply. And the way I would think of the all or none are exceptions, it isn't just another exception. So tough. I don't think that was a tough one. I think in the test itself, be prepared for a pretty more straightforward version of this one, where, we end up, not having to deal with the exceptions, but now somehow you learn new stuff is by doing this. As much as you have to get a straightforward kind of a question where you got to be able to perform on that. By the way, my updated quote as a result of that would be now 14 round lots, 12 for myself and 2 for the customer. And then whatever I got to do for myself, I got to do for my customer. All right. Ooh, tricky. All right, 27. Well, let me clean up my slide. A trade is executed at 11:15 a.m. The company trade report, trade report must be reported. And boy, this is just straight out of the gate testable, right? It's got to be reported within 10 seconds. That is very much a test question. That's normal business hours, right? And, boom, great poor man's flashcard. Certain questions like this one, if you miss them, angels weep for you, right? I mean, that's just, it doesn't, that's a layup as you want to think of it as that way. 28. A customer sells short 500 shares of Bertram lab stock on Tuesday. However, the customer's broker-dealer has trouble locating these securities for delivery by the settlement date. What is the deadline for closing out the shares? So we have from the customer a fail to deliver, right? And a fail to deliver must be closed out on the next business day after the failed settlement. So that would be T+2, which is Thursday. And then the next day would be Friday. Now, remember, this is an intentional short sale. This isn't somebody who was selling long and didn't make delivery. So, there's two types of fails to deliver. The fail to deliver on a short transaction is much more a sense of urgency than a fail to deliver on a long trade, somebody who's selling long. 29. Which of the following is not permissible authorization method for an institutional client to give permission or give consent to net trades, right? Net trades. Receive verbal consent from the client prior to the trade. Now, it's an institutional customer, so that sounds pretty reasonable. I mean, they're big boys or big girls. I shouldn't say that because institutional means they're not living, breathing human beings walking planet Earth. But, B, receive written consent from the client by settlement. And that says we're doing it after the fact. So we don't like, after the fact. All right. Let's see. Prior, after. C, provide the client with negative consent letter prior to the trade. Now, negative consent, and what that means in plain English is no news is good news. So I don't have to have you sign this thing and send it back. I'm just assuming that you've received it, you've read it, and you understood it. Receive written consent from the client prior to the trade. So given on that answer set and process of elimination, I'm going to go for B. Now, don't tell Knopman I said this because he'll be upset, but A lot of test writers, I don't know who wrote this question, but a lot of test writers start with the wrong answer, distract, or right answer, and then they reverse engineer the rest of it. And so sometimes I say to people, we don't want to guess unless we don't know, but too long to be wrong is a test taking trick. So, we look at those long answer sets and we say, if it's a long answer being offered to me, wow, that's either, a right answer or a heck of a wrong answer. So, and then here the answer is B. And key point is prior versus after the fact. 30. AG Securities, a FINRA registered market maker, is displaying a quote in a NASDAQ listed security 784/5. So I'm willing to buy 400 shares into my inventory at 7. I'm willing to sell 500 shares out of my inventory at 8. A customer firm contacts the register rep, places a market sell order. Now listen, as 57s, you can't be fumbling around with these kind of situations. What this is continuing to torment you on is, do you understand the quote is from the market maker's perspective, right? So if the customer is selling, that means we as market makers are buying it into our inventory at 7. This is going to be a problem. If you're struggling with this kind of a question, you're at risk, because, that's a big part of what you got to be able to do. And you got to, a lot of times when people are struggling, they're on the wrong side of the quote, right? So you want to, when you're, as a test taker, you want to get yourself on the right side of the quote. And the quote is from the market maker's perspective. That should, I hope, with enough effort on your part, become an aim and shoot point and click question. An IPO lockup period is designed to prevent the company's share price from being depressed because of, well, what depresses company share prices? Too many sellers and not enough buyers, right? So that's what we're trying to prevent, is having too many, sellers. And remember, the lockup is about people who have a large number of shares. So, when the lockup, a lot of times when the lockup's over, the stock starts dropping, because once the lockup's of people, they start dumping the stock. And so, yeah, this is kind of an aim and shoot point click question. Early sales by insiders. It's usually, the lockup is usually 6 months from the IPO. There are exceptions, but 32. Which two of the following describe the market attitude of a writer of a straddle? So again, you're either buying volatility, it's your friend, or you're selling volatility. And, and when you buy a call, you're buying upward volatility. When you sell a call, you're selling the volatility. I think you're going to be wrong. Long put, you're buying downward volatility, and short put, you're selling it. So here I'm selling upward and downward volatility, meaning neutral. I don't think the stock is going anywhere. I think, or if it does, it's going to stay within my trading range. So I'm bearish on the price of the underlying asset. No, I'm neutral. When I'm collecting premiums, remember, if the stock doesn't move, I still win. So neutral, yeah. Neutral on the volatility, yeah. 2 and 3, I like that one. PS, it has unlimited risk as well, right? So the answer is 2 and 4. Neutral on the volatility, 32. Volatility, net neutral on the price. That's 2 and 3. Let me get my annotation tool. All right, I wanted to stay within the trading range. Anyways, what I just wanted to make sure I stress to you is that has unlimited loss potential. So, if you're wrong, I think it goes out of there. All right, 33. Zoe wishes to buy 100 shares of XYZ when it's trading at $42 a share. The broker-dealer holding her account executes the trade at that price and takes a profit of 110, a markup. What price will be reported to the reporting facility? So, you need to know when we report, it doesn't include the markup. It's just going to be the 42, right? So it's exclusive of that markup. 34. What is the minimum amount of stock a market maker must sell at the quoted price within 30 seconds of receiving an order to buy 1,000 shares? Well, if you don't do it, it's whatever your quoted size is. Otherwise, very testable. I haven't seen a practice question yet, but if you don't do that, very testable. It's called backing away, right? Backing away is when a market maker fails to honor a firm quote. That's very testable. And then, I'm going to hear from what's called the under the COP Code of Procedure, the Department of Enforcement. They're going to say, Dean, we've received some reports. You're backing away from your trades. Why don't you come up here and explain yourself? 35. The prohibited practice where algorithmic traders enter and then quickly withdraw large orders for the purpose of creating confusion in the market for their own benefit is referred to. I call it spoofing, but it's not marking the open. It's not shredding. Shredding is turning large orders into smaller ones. That's a problem. Quote stuffing. There we go. Layering is what you do to launder money. So it's going to be C. I would also know that's can be referred to as spoofing, when you put in large orders to buy or sell to, spoof, other people. 36. For OTC equity securities, market makers and broker dealers must review information about the issuer whenever they, this is testable. So you should have a general understanding of what you're making, what the company does that you're making a market in, right? So initiate or resume OTC quotes. So, that you should know Apple does not really, it doesn't raise apple, it doesn't have an apple orchard that they sell, technology products, whatever the case may be. I like that one. The Knopman phraseology, I told you this is my first exposure to this exam. I like their phraseology, but you know what? I always suggest as a test taker that what you want to do is project the right answer. And so it's like Dean looking for spoofing and it's not available as an answer for me. But sometimes when you get on the test, if you get an answer and you say, man, I thought I knew this, you want to just continue to kind of look around. So I'm just saying, if you see different phraseology, this is very testable, but you might see it in different phraseology. So just be prepared for that different phraseology is my point. I'm not, listen, I'm not taking a shot at Knopman in their phraseology. I'm just saying, make sure if you're doing poor man's flashcards that you don't, I'm hoping that you're not so locked into memory that you can't recognize the same answer expressed or question expressed just a little differently. That's what I'm saying. So 37. Because I'm hoping, by the way, that this goes well for you. And again, if you do Knopman, please mention that you found it on my channel. And because I'm very hopeful, I like Knopman's content. I'm very hopeful that maybe I can get permission to do some of their other exams as well. So, in there, who knows, and backstage at their place, they're probably saying, I don't know if it's going to be a good idea or a bad idea. So let's try and convince them it was a good idea, right? Which of the following would not be the outcome of a clearly erroneous trade? Well, if it's clearly erroneous, we're not going to give the assignment of the execution to another member firm, right? It's in the aftermath doesn't include the assignment here, right? So see. I would just know that you have to appeal if it's a lot of times in the business, we refer to this as a fat finger trade. It's a trade and then you have to appeal to the market committee and then, they can tell you whether you have to honor it or not. A copy machine technician has learned of a major product recall announcement that will have a significant impact on corporate profits while working at the site. So let's just phrase that into legal terms. He's in possession of material non-public information. Material non-public information. Material means something that would alter somebody's investment decision. He contacts several friends, and tells them to dump the stock. In this situation, is he a good friend? No. The technician is not validated insider trading because he's not a corporate insider. And you don't have to be a corporate insider to violate the Insider Trading Act of 1988. In fact, part of the expansion of 88 was to make more people exposed to, going to jail for this. The technician is an insider and has violated insider trading regulations. Well, he's not an insider. He's not an officer, director, or principal stockholder, but he is in possession of material non-public information. So let's move on. I like that, but let's see what else we got offered. I always say RTFQ, read the full question, and RTFA, read the full answer set. See, the technician has not violated insider trading rules because he did not make money. No, very testable. You don't have to make money. You could give the information to someone else and that someone else does it, then you're still held accountable if you received any personal benefit. Don't you love that language? And that specifically reads something as simple as enhancing your friendship or reputation. So obviously here, he's going to enhance his friendships and reputations with these people for doing it. So let's look at D. I like D already because remember what Dean said, too long to be wrong. Boy, this one is really long. So D is in dog. Although the technician is not an insider, he has violated his fiduciary responsibility. Ooh, I like this, toward the confidential information. In other words, is a fiduciary within that corporate campus where that machine is, that's not his information. That belongs to the company. And is guilty of misappropriation. There we go. He stole that information. So the answer there is D. I kind of like that one. I like that one. Alternative display facilities. Who is eligible to participate in the alternative display facility? Well, any FINMA member in good standing is allowed to participate in alternative display facilities. 40, which two of the following statements about the SIBO's VIX index are true? Sometimes known as the fear index. I like this question. I like what it's asking about the definition of this thing. And the answer is 2 and 4. 2 and 4. I would definitely know what the VIX is about. I think this is our first multiple. You won't encounter any multiples on the actual 57. Vacation withdrawals are not allowed for NASDAQ market makers. Well, it depends how big your firm is. And the assumption here is that if you have more than 3 NASDAQ level 3 terminals, you should definitely know level 1 NASDAQ data feed shows you the inside quote. Level 2 shows you the market makers. And saying I have a level 3 NASDAQ feed terminal is synonymous with saying I'm a market maker. And so that, if you have more than 3 of those things, you're a pretty major operation. And we figure you should be able to take care of, managing 57s who are taking vacation, right? With the assumption is you have more than 1 57 who can man the desk in the absence of the trader that's going on vacation. So the answer is C. 42, which of the following is not a type of order? So you should definitely know market not held certainly is. That's where I tell the floor broker to do it at whatever time and price he thinks look good. You should know it's a stop limit, which gives us is a type of order. So by process of elimination, it's going to be B or C. And there's no such order as a pending cross. That's just, fictitious. All right. So yeah, C. By the way, this is another area I told you, I just purchased this off the shelf and I noticed that they have some videos for each of these. I'm not sure if Knopman's going to have the video that shows you the review of various orders. It's definitely, you want to get a handle on that. And I would highly recommend it. If you're coming to this 57 and you just recently took a test and you're pretty comfortable with market orders, limit orders, stop orders, all or none, immediate cancel, then, maybe you don't need to do as much base knowledge, but I would warn you that if that's not the case, you definitely want to, review that section. All right, 43. 3 sell limit orders are entered on NASDAQ with 1 minute interval between each entry. One order is GTC and the other 2 are day orders. Now, without any type of a qualifier, all orders are considered day orders. The limit prices are 13.19, 13.21, 13.25. So it looks like the person who's willing to sell at the best price now is at 13.19, right? So what we're testing on here is price priority. The person with the better price is going to get, filled first, right? And so the person who's willing to sell at the lower price here is the one who's going first. So the answer here is D. Now, if it was somebody who was buying, it would be the person who's willing to buy at a higher price, right? So again, that can be something you can struggle with. Again, you want to kind of review orders and the perspective on the order. A lot of times when you're doing your practice questions, you might be missing, and my experience has been when people are missing, they're on the opposite side of the question. So issuer directed sales sometimes are referred to as the friends and family list, right? This is where I'm taking the company public and they say, Dean, I want to make sure these people get the stock, right? Through directed share programs. Yeah, this is where, for example, when GoPro went public, he said to the underwriters, I want my GoPro customers to be able to get an IPO allocation. So set aside some stock for them. So directed sales. by the way, sometimes we refer to that colloquial as friend and family list, and you can't use the friend and family list to violate the restrictions on IPO allocation, right? I can't have the issuer say, hey, give me some. No. Which of the following is permissible under federal securities law? Uh-oh. That sounds like serious stuff, federal securities law. Circulating unconfirmed information about a company that will cause an uptick in trading volume. Well, that's bad, but I don't think you go to prison. When we say violations practice is permissible, is permissible. So I thought it was going to be about what's not permissible, what we're going to jail for. A is not permissible. Trading with a goal towards achieving a specific closing price, that's called pegging or capping. I'll leave it to you to review pegging and capping. Definitely not okay. Trading amongst party to create the false appearance or an appearance of heavy volume, that's called painting the tape. And that is certainly a problem. Affecting a trade after material information about the company has been released. So it's material, but it is public, right? So material non-public. This is material public. I got into it with a guy one time, and he said, Dean, he's coming after me. I had posted this information on the internet about his company. He was kind of a penny stock crook kind of a guy. And I said, listen, you're confused about what that is. That was public information that I took the time to go to the courthouse and find out and post on the internet. If anything, I'm making it easier for people to evaluation. For me to get in trouble, by the way, I think it's very rich for you to accuse me of, violating securities laws. But for me to be in trouble, that had to be material non-public. That is material public information, and I'm now releasing it out there. So, I'm not in trouble. So D is now the market can evaluate that information. 46. All of the following are similarities between a short call and a credit call spread. So this is the second time we've kind of encountered this idea that, short calls would make you a dumb bear, because as a dumb bear, you're bearish and you're taking unlimited risk, and credit call spreads make you a smart bear because you're putting in a ceiling. You're taking part of the money you got from the lower strike call and buying a higher strike call just in case. So they're both bears. Yeah, the way I think it is, one's a smart bear and one's a dumb bear. Both have limited maximum gain. Yeah, the naked call is your gain is the premium. You agree to be a potential victim. Nobody victimizes you, and you walk with the money. And at a credit call spread, you get the whatever that net credit was. Now, I joke, I think you're kind of a jerk of a customer. You say, Dean, had I done the naked call, man, I would have made more money. I wasted my money for the higher strike. I said, well, that's because if we're wrong, right? And that's our ceiling. And they both do not have unlimited risk. That's the whole point of doing the credit call spread, is that you have limited risk. So the answer is D. 47. Which of the following statements is not accurate in relationship to the 5% markup policy? Well, it doesn't say 5% here, but that's what it is. And it's not a rule. So remember, policies are different than rules. Policies are for the guidance of wise men and women. So a pattern not accurate markups is of heightened significance above and beyond markups on individual trades. That is indeed, the following statement is true, is that's accurate. The 5% policy is a guide, not a rule. I just brought that, right? It's a guidance for wise men and women. The rules for the blind obedience of fools. This is a policy. So B is accurate. I kind of like that Knopman is using accurate instead of true or false, but they're kind of similar language, right? So I'm looking for the thing that's not accurate. I'm looking for the thing that's false. So, if we could, again, remember we said one of our things we might want to consider doing is, putting a T or an F next to it, right? So in this case, T means accurate. And then false would mean not accurate, right? A broker-dealer's contemporaneous cost may be used. Yeah, in certain transactions where there's no independent market, we're going to be using our contemporaneous cost. That's true. A broker-dealer may justify markups on the basis of excessive expenses. No, I don't get to pass that on to you. It's based on the competitive market for the security, right? Sometimes you get a test-taking trick would be what I call reduction to the ridiculous. Reduction to the ridiculous is what would it look like if I said, well, yeah, I have a higher expense structure because look at my beautiful office here, and somebody's got to pay the freight. No, right? So the expense structure is your problem, not the customer's. So I think what I might want to do on this one again is we've talked about this. We're coming up on an hour here, but What we might want to do is turn this into a poor man's flashcard again. And what I'm going to do there is I don't want to be studying false information, right? So now I have a good poor man's flashcard. The other thing I would know is it doesn't apply to the primary market. It doesn't apply to the primary market. 48, 10b-18. I told you to be careful and review 10b-18. This is about an issuer buying its own securities. And so the answer here is 30 days. Right? Minutes, excuse me, 30 minutes. So 30 minutes, right? What am I thinking? I need another cup of coffee. So it's C, 30 days. Kevin is a registered rep assigned to the holidays joint brokerage account. So the holidays are customers of the broker dealer. While Kevin is on vacation, other rep June agrees to cover the holidays account for him. If the holidays buy 200 shares of stock from June while Kevin's on vacation, whose name will go on the order ticket? Well, you always want to think, that somebody in the future is going to be looking back on this moment and that we better have the proper documentation in place. And so we want to have both Kevin and June's name on that, right? We want to note that this is Kevin's customer that June is covering. So we want both of them on there. 50, when a sell order is marked exempt. So this is the second time we've kind of seen this thing. And what we're saying is we're not subject to the, uptick or limit up or limit down. That's kind of what that's saying, right? So the answer here is A. Let's see what our other choices are. Short sale must be executed price within 10%. No, that's what exempt means. Short sale may exceed above. No, yeah, A is the best answer given that answer set. At 2 p.m., the S&P 500 drops 8%. Ooh. So we should recognize that the memory work, practical application is 7, 13, and 20. So 7% down, 13% down. We take a 15-minute strategic pause. 20%, we call it a day and say maybe tomorrow will be better. Okay, so then it's recovered to a 5% drop. Then at 3 p.m., it's back 8% down. Which of the following is true regarding the circuit breakers that result from this trading activity? So we should have been able to eliminate A, because A would be 20%. So A is out. We should note it's not going to be ever one 30-minute period. So it's going to be not two 15-minute periods. It's halted for 15 minutes, right? So the 15 minutes occurs, and then it would have to go all the way down to 13. So it's going to be what? Boom. So we don't go 8, it go all the way to, I call it the low water mark, right? So that's the way I think about it. The way Dean thinks about it is not testable, but 52, to ensure best execution of a trade, which market must a FINRA member use for execution? The best at which market? The one with the best execution, right? So yeah, I think that's pretty straightforward. I'm trying to measure most liquid. Well, no, the most liquid may not necessarily mean the best execution. So, but it's very subjective. In other words, even if I don't use the one with the best execution, I have to be able to articulate why I went somewhere. A NASDAQ listed put option trades no bid for 10 seconds before a trade is executed. What must happen to trigger an obvious error? So how would we recognize that there's a glitch in the systems? And the glitch would be that the other one, the option one strike above also has a no bid. I'm not so sure. I'm sure that Knopman gets debrief. I've never had any debrief that anything like this is on the exam, but again, I'm not doing a bunch of 57s. And as I told you, Knopman is one of the last, person is still providing 57s to customers. So I wouldn't second guess it. If they put it in their benchmark, it probably has a reason for being there. 54. A market maker AA is currently bidding 53.50 and asking 54.10 on XYZ stock with a corresponding size of 12 and 14. So I can't stress this enough. You always want to take a deep breath and say, okay, I'm the 57. I'm the one on the desk. I'm the one who's going to be looking at the quote. The quote is from my perspective. And I'm saying right now, I'm willing to buy 1,200 shares into my inventory at $53.50. I'm going to sell 1,400 shares out of my inventory at $54.10. $53.50 is my bid. $54.10 is my ask. Currently, the inside market of the stock is $53.50. So it looks like I have the inside bid. And asking $54.10. 50 inside market is $53.80. There we go. So I'm not competitive on my ask, but I am competitive on my bid with a corresponding size of 12 by 8. So there is, we don't know which market makers, but there's a market maker out there willing to buy 1,200 shares at $53.50. Hey, that's me. And there's some other market maker, not me, willing to sell 800 shares at $53.80. Market maker A would be required to update its quote to reflect which of the following orders. So we're looking at limit order protection here. And so market A receives an order to buy 500 shares at $53.50. Important, by the way, to remember that the customer doesn't have to tell me that's a limit order. If they specify it's a limit order, then I act accordingly. So here I say, oh man, okay, so the customer wants to buy it at the same price I want to buy it. And when the customer uses a limit order, he's on the same side of me. Right? When you're using a market order, he's on the opposite side. So he wants to buy at the same price I want. So now I would update my quote. The answer is A. And that would now be, my size would not be 12, it would be 17. Right. So now there'd be 1,700 shares. By the way, outside looking in, people don't know that, but that means, I want 700 shares for Mr. Manning. And I want, 500 shares for Mr. Manning, 1,200 shares for myself. Now, the other scenario, remember, is that as we move forward, whatever I do for myself, I have to do for Mr. Manning. So, if I buy 200 shares for me, he still has protection on the remaining of 200 for him. He still has protection on the remainder. Let's see, B. Market maker, I receive an order to buy 15,000 shares at $53.51. Well, remember, we said it doesn't apply to block trades, right? Market AA receives an order to buy 500 shares at $53.40. That's not competitive. I'm willing to pay 10 cents more, not competitive. Order to sell $54.10. If the customer wants to sell at $54.10 and I want to sell at $54.10, but that's not the open market, right? So I would fill him, right? He would be able to get filled. Risk management controls for broker dealers are designed to ensure supervision and control procedures are in place, prevent trading losses. Now, for trading, it's about this idea of erroneous orders. Okay, so I will take a strategic pause here. Let me do that. I'm going to quickly review, see if I missed anything. If so, I'll tell you what I missed, and if not, then it will be good to go. So I'll be back in a couple minutes. Okay, it looks like Dean did a pretty good job. That's good news. So I hope you found that helpful. Please let me know in the comment box. I know there's not many of you 57s out there, but please also, if you do go to Knopman, drop my name, say, hey, I saw the explication from Dean on the YouTube channel, and that's why I'm here signing up for Knopman. So I'm hoping that Knopman found this helpful for their promotional efforts. They deserve to be promoted because they do a good job. And importantly for us, maybe they'll give us some permission to do some more free supplements on the channel for some of their other good stuff. So anyways, remember, inch by inch, your 57 is a cinch. Yard by yard, your 57 is hard. And I'll see you next time. Bye-bye.